Recently, I read an article from Business Insider on Zimbabwe's richest man, Masiyiwa. He was asked about the 7 rules for success in his businesses. Interesting for me was that the first reason he gave is that you need to understand your numbers. And he stated that you don't need to be an accountant for you to understand your numbers. But understanding your numbers is extremely important if you want to grow your business. And so today I want to look at why good financial management is really important for the success of your business. I'll look at reasons why many entrepreneurs avoid keeping a set of financial reports or even setting up accounting systems, and how you can go about setting up a simple accounting system so that you can start utilizing the numbers from your business. Let's get started. Hello there and welcome to another episode of the Ndalama Insights Business Show with me, Mukonki Mukonkela. Today I want to look at why good financial management is important for the success of your business. Now, there are so many reasons why entrepreneurs don't keep a set of financial reports. Maybe I should go back a little bit and explain what financial reports are. Financial reports are what you get at the end of the month or at the end of the year if you've been keeping a record of all your transactions that are happening in your business. These transactions include your sales, purchases, wages, and other general expenses that relate to your business. So when you're operating a business, when you keep a record of all the transactions or activities that are happening in your business or in an accounting system, we call that data entry or keeping a record of your transactions. It is very important that as your business is operating, you are actually recording every activity in your business. If you buy something, you're supposed to get a receipt or an invoice, which you should file and also post in an accounting system so that at the end of the month, these invoices and receipts are building up to a report. Now, getting receipts and invoices for your sales and your expenses is not just about keeping them in a folder. It is about posting these transactions in a systematic way in an accounting system so that at the end of the month, you can make use of the information. And this is where the concept of the chart of accounts comes through. A chart of accounts is a way of organizing your business transactions so that you can create meaningful reports that can help you understand how your business is performing. There are 5 major categories that you need to be aware of. There are 2 categories that relate to the profit and loss, which is one of the financial reports that we're going to talk about. The other 3 relate to the balance sheet. So let's take a look at the categories that relate to the profit and loss or the income statement. The first category of account codes relate to your income. The income account codes relate to all the sources of income that you make in a business. Meaningful accounting codes that relate to your income must be broken down by each major category of your income stream. Now, before I go further, you need to know that the chart of accounts has an account code as well as a description. So for example, you might have income account codes that start with 100. And if you've got 3 major sources of income, you can break your income account codes into 100, maybe for your major revenue source. This could be, for example, sales of handbags. Then you can have 101 for sales of shoes. And you could also have 102 for sales of shirts. So that is the income category. The next category, focusing on the profit and loss, are the expenses. So you need to understand that there are 2 types of expenses. We have the direct costs and the general expenses. So even as you are setting up your chart of accounts, keep in mind these 2 categories. So you also need to look at what number you are going to give your direct costs. Maybe you could choose 300. So all your direct costs should have a 300 account code. Then you might look at the general or administrative costs. You might also pick a 400 to represent your general administrative costs. So these are the 2 major categories of your chart of accounts relating to the P&L or the profit and loss. You have your income account codes and your expenditure account codes. The balance sheet has 3. You have your asset account codes, which is comprised of 2, your fixed assets and your current assets. Then you have the liability category, and finally you have the equity category. The concept in terms of what account codes you choose are similar. So you might decide to say your fixed assets are going to start with 500 and your liability could start with maybe 600, and then your equity could start with 700. So that is the concept of your chart of accounts. So once you collect your transactions, you now need to allocate each transaction to an account code. If it's an expense, you need to post it to that expenditure account code. If it's a revenue, you need to post it to a revenue account code. If it has to do with a fixed asset, it needs to go to the fixed asset account code. The more you do this, the better your information becomes, and the easier it is for you to produce a set of reports that you can make use of, such as the profit and loss. Because as you post transactions about your income and your expense, you can then ask your system to give you a report about the performance of your business. What is your profit? And you know that profit is determined by looking at your income minus your expenditure. The balance sheet is the report that tells you your assets and how they are financed, either through equity or liability. And it tells you the net worth of your business. And so if you can regularly post your assets, your equity, any liabilities, you are then able to know how much your business is worth. What is its net worth? So that is what these two reports tell you, and this is where the information comes from. Now, I've heard so many reasons why entrepreneurs don't want to keep a set of financial reports. One reason is that Xero is going to know how my business is performing. They'll know my profit. So would you rather run your business blindly because Xero is going to know how much profit you are going to make? You see, so many times people wonder why their businesses don't grow. And yes, this is really puzzling. I believe one reason is because many people don't understand their numbers. Yes, it's good for you to wake up in the morning, go to the workshop or go to your office. But if you don't understand the numbers, then you are wasting your money as well as your time. What do numbers tell you about your business? Let's take a look at this. One important thing you get to learn from your numbers is whether your business is profitable at all. And this you get to see from your profit and loss. Well, you could say that I know my numbers off the top of my head. I've got a memory that is very good. I know how much I'm selling and how much I'm incurring in expenditure. So I know how much I'm making. I don't know how big your business is, but if your business is really busy and there are so many transactions happening at the same time, it's really hard for you to keep a mental record of how your business is performing. The best way is to keep a record in an accounting system or even in a manual book. You see, numbers don't lie, and it's not about a mental memory, but about the actual figures that you are seeing from a report. A financial report such as an income statement will tell you exactly how much income you made in a period, what the cost of making that income was in form of the expenditure. It will tell you your gross profit margin, which is the profit directly related to the production cost or to producing a service or a product in your business. Once you understand your gross profit margin, you will then be able to understand whether you can afford other expenditure such as office rent, extra human resource, and so on. So if you take into account the administrative cost or general expenditure, then you arrive at your net profit. The net profit is then the profit that you can use to either reinvest in your business if you want to grow your business or use it elsewhere. Now, I've seen so many entrepreneurs look at just the turnover or the sales and think that they're doing really well. Others even go to an extent of getting that money from the sales and using it for personal usage without realizing that they could actually be trading at a loss, because, well, most of the times they've got a mental memory to say we are making a profit, and so they end up trading at a loss and end up in dire cash flow situations. When you are growing a business, especially a business that is of value, you need to invest in assets as well, especially if you intend to seek external help in terms of access to finance. The financiers want to see what your stake in the business is, and they get that information from your balance sheet. So your balance sheet will tell you how many assets you have, what their values are, and how you financed those assets. Who are you owing, as well as the returned earnings. How much money do you keep in your business? That gives you your net worth. Now, it's not just about knowing what this information is, but it's about how to make use of this information to improve your business so that your business can grow and it can be stronger. When you look at the profit and loss, you can make use of that information by checking which areas you're actually overspending in terms of expenditure, or even which areas on your income you're underperforming. That way you can bring yourself into alignment with your targets, your income targets as well as your revenue targets. When it comes to your balance sheet, it's good to keep an eye on your current ratios or your cash flow. You get that information from your balance sheet. How liquid is your business? Can you afford to pay your liabilities from your current assets? So this is where we look at liquidity ratios, such as your current ratio, which is the ratio that looks at your current assets compared to your current liabilities. Can you afford to pay your current liabilities using your current assets? And the balance sheet also tells you or shows you how your assets are financed. Are you using short-term finance or working capital to finance long-term projects or assets? If you are doing so, that's really dangerous. It also tells you how long your customers are taking to pay you. This is the accounts receivable aged analysis, or the accounts receivable days. They tell you how long your customers are taking to pay you. And so there's a lot of information that you get from your financial reports that can help you to grow your business in the right direction. You might already know that many businesses fail because of lack of good financial management, and others also because they run out of cash flow. And this is because they do not keep an eye on their numbers. So it is extremely important that you keep good records so that you can produce reports that you can then look at and understand. Another reason that I get as to why entrepreneurs don't keep a set of financial reports, they say it's because it's costly. It's expensive to create an accounting system. What normally happens is when you are starting, when you're really small, you don't see the significance of keeping records until the day you want to seek financing from a bank. And this has happened so many times. So when your business was smaller, you did not think it was relevant for you to keep a set of financial reports. Now your business is getting a little bit busier and you need to get a working capital loan or a bank overdraft. You get to the bank and the bank tells you to say, we need management reports. In addition, we also need audited financial reports. Most of the times that is when you think about the accountant, that accountant that you know about. Unfortunately, I'm one of them. Many times when you are rushing to see me, when you're in that situation, there's actually very little I can do. Because most of the times, SMEs who are in that situation have got a terrible history when it comes to keeping records. They don't have the receipts, they don't have the invoices, the bank statements are mixed up with personal finance or transactions. It is a complicated mess. It is like really a complicated mess. It is not even incomplete records, it's a complicated mess. I don't even know where to start from. When you are in that situation and now you want me to help you, it is really hard because yes, we might create a set of financial reports, but the numbers won't add up. And many times, many loans fell through because of that. So if you are watching this video today and you just started out in business, I encourage you to keep a record of all the invoices and receipts in a box file. Post them in some kind of accounting system. It could be a book or a simple accounting software. So many times I've spoken about Xero. It's a really good accounting software that can get you started in managing your business well and in also understanding the performance of your business. You get key insights from Xero on how your business is performing, and that way you're able to read these reports and take corrective measures or action so that you are growing your business sustainably. Well, this is all I had to share in today's video. If you are just starting out in business, please do start keeping a record of all your receipts and invoices, both for your sales and your purchases, because one day you will need this. And when you come running to me, it will be easier for me to produce a set of financial reports that you can take anywhere, even to your bankers, and guarantee you that you get that loan. If you enjoyed today's video, do consider subscribing to my channel down here and also like and share the video. Thank you so much for watching and see you next time.